Welcome to Beyond the Benchmark. I'm Ryan Kasper with LSA Portfolio Analytics, and this is your IPC short. Last week's market action felt a little more optimistic, but underneath the surface, investors are still wrestling with the same core issue. How do markets handle an economy that continues to grow while inflation pressures refuse to fully go away? Economic data was mixed again. Manufacturing activity improved more than expected in May and stayed firmly in expansion territory, helped by stronger output and hiring. Services activity also remained positive, although growth there was much softer. So the broader economy is still moving forward, but businesses are clearly becoming more cautious. One of the biggest themes right now continues to be rising costs. Both manufacturing and services surveys showed input and output prices climbing again, back near the highest levels we've seen since 2022. Companies are still dealing with the ripple effects of higher energy prices, supply chain uncertainty, and geopolitical tensions tied to the Middle East conflict. At the same time, consumers are feeling the pressure too. Consumer sentiment dropped again in May to the lowest reading in the history of the survey, going all the way back to the 1950s. That's a pretty remarkable number. Inflation expectations also moved higher, with consumers increasingly worried that elevated costs for fuel, groceries, and everyday goods may stick around longer than expected. Housing data painted a similar picture. Housing starts weakened, builder sentiment remains soft, and affordability pressures continue to weigh on the market despite the broader economy holding up relatively well. Now, despite all of that, markets actually moved higher last week. The S&P 500 extended its winning streak to 8 consecutive weeks, helped by hopes for progress in U.S.-Iran negotiations, easing oil prices, and continued enthusiasm around artificial intelligence and technology spending. Small caps and cyclical sectors outperformed, while bonds also stabilized as Treasury yields pulled back modestly. So what's the takeaway? Right now, markets are trying to thread a very narrow needle. Investors are hoping for slower inflation without a meaningful economic slowdown. That's possible, but it's becoming increasingly difficult as energy prices, geopolitical risks, and sticky inflation continue to pressure both businesses and consumers. This is exactly the type of environment where discipline matters most. Markets can remain resilient even while risks build underneath the surface. That's why diversification, quality exposures, and active risk management continue to play an important role in portfolio construction. We'll continue watching inflation trends, interest rates, and developments in the Middle East closely in the weeks ahead. Thanks for listening to this IPC short from Beyond the Benchmark. I'm Ryan Kasper with LSA Portfolio Analytics.